Bring in E.J. Antoni, an economist and research fellow for regional economics at the Heritage Foundation, and Jack Bouroudjian, chairman of the Global Smart Commodity Group. So, Jack, first to you. I mean, I was just looking, the last time there was a big shutdown or a partial government shutdown was 2019. The market during the shutdown actually ended up 10%. So sometimes it may not be good or bad news, but sometimes it's actually good news.
But remember, David, that was a period where we actually saw the Fed actually with easy money and easy money policies. This is the first time we're actually seeing this type of shutdown being threatened when we're seeing the Fed draining the system. That's a headwind in and of itself. So let's see how this all plays out. And I'll say that. And of course, the bottom line is this needs to be done. The reality is that debt is spiraling out of control, and either Congress does something or the bond market will do something.
Well, E.J., the size of government is not diminishing one bit, and the cost of that debt, it keeps growing. Our debt, I was just looking at the debt interest payments that the government makes, they're twice what they were just in 2019, well over $600 billion a year now.
Absolutely, David. In fact, if you just look at what's going on with interest rates right now, and you can go all the way down to the shortest maturity, all the way up to the 30-year bond on U.S. Treasuries, and you extrapolate out to what that's going to do to the debt during the next fiscal year, we're looking at $1.5 trillion in interest payments. That's just on interest on the debt. I'm not talking about funding any kind of essential government services here. Just in interest. It is going to bankrupt us, and right quick.
Well, now, Jack, today we had core inflation numbers, the PPC numbers, or the PCE numbers, forgive me, and they were actually a little better than expected. It was down a tick from the expectations. The Wall Street Journal, Nick Timarios is reporting this as good news. He says that inflation is actually cooling. It could stop the Fed from raising rates. What's your thought about this?
The Fed has told us they still have a long way to go. It's going to be higher for longer. And I think the market's starting to come around to that. The reality is that, if the Fed starts to ease over the course of these next few months, they're going to lose credibility. And that's going to really hurt the markets down the road. Right now, they're in a position where they have got their hands cuffed. Right? And they really cannot do much. And they're at the mercy, basically, of what is happening to market conditions.
E.J., then we have the problem of growth. And I would say at very best, we're kind of coasting along here. That's at best. And as George Gilder used to say, if you're coasting, you're going downhill. Is that still applicable?
I think so, David. If you look at a lot of alternative measures of economic growth, like the Philadelphia Fed has their GDP plus, for example, that's at just 1.1% right now, not the 2.1% that we got in the latest revisions on GDP. So we have a lot of indications that the economy is absolutely coasting, but coasting to a stop. And by year's end, maybe the beginning of next, there's a good chance we're moving backwards. In other words, a recession.
And, Jack, we do have oil prices going up. We have gas prices going up. Everything that uses oil keeps going up. So it's while the core, which, of course, takes energy and food out of the equation, it may be doing a little bit better, the stuff that Americans have to deal with is not.
Yeah. And diesel is another one that people don't talk much about. And that's really one of the core things. And, and remember, this is happening with the dollar actually going higher. Imagine if the dollar were going lower. I think the impact would be even greater. So you're spot on, David. I think what we have to do is pay very, very close attention to what happens with oil. If we see it spiking over $100, $110, that in and of itself could be something that stalls the economy a lot harder and faster than people expect.
And E.J., we thought that the UAW thing was at the beginning of the week. We thought it might be kind of working its way out, particularly with Ford. But now they're expanding. What's happening with that?
Well, unfortunately, both the automakers and the auto workers are running up against the brick wall that is Bidenomics, which has made everyone poorer. As much as we talk about the headline inflation numbers and consumers spending 17% more on average for all the things they buy, prices for businesses have actually gone up even faster. That means these businesses have smaller margins with which to grant wage increases. And as a result of that, they can't afford the demands of the labor unions. And both sides now are at each other's throats when they should be pointing the finger here in Washington, D.C., which is the cause of inflation and the cause of both of their problems.
So, Jack, real quick, are you guys, and I'm going to ask both of you, are you guys recommending we just kind of hold our ground and maybe get out of stocks a little bit, get into some of those 5% interest rates from a 1 year or even a 6 month?
It's funny you said that. I just did that today. If you listen to what David Tepper said, and he's one of the smartest guys on the street, he just put money into a 6-month term, and he's getting 5%. So that's really what you want to do.
E.J., you can't beat that, can you?
It's safety.
Well, here's the thing, David. I think we have another interest rate hike before the end of the year from the Fed, and then we may have more to go after that. I think history should be your guide here. We are heading towards a period of both stagnant economic growth and inflation, stagflation. So look back at the periods in time when we had that in this country, like the late 70s, early 80s, and choose the same sectors that did well back then.
Good stuff. Jack, E.J., thank you very much, gentlemen. Good to see you.